Nikkei 225 just screamed higher by 677 points. It's sitting at 71,320. The monthly trend is strong buy. The weekly, the daily, the 5-hour, the 1-hour, all strong buy. And yet, if you're blindly buying here, you're walking straight into an institutional trap. There is one danger zone and one hidden opportunity right now. I'll show you both. This is not a time for hope. This is a time for a plan. On screen you can see the number that changes everything. 71,643. Trap. 2 scalps plus 1 swing. Stay to the end. I'm handing you 2 scalp plays and 1 swing trade you can execute today, complete with exact stops and risk-to-reward ratios that let you sleep at night. Here is my session bias, bullish, but sharply fading as we press into this resistance. Until 71,643 breaks on a closing basis, every long is a high wire act. The momentum is real, the trend alignment is breathtaking, but the oscillators are screaming that we are stretched to levels where violent mean reversion trades are born. Write this number down. If we break and hold above 71,643 on the 4-hour close, the entire structure resets and we chase the breakout. If we fail there and the 60-minute chart prints a bearish engulfing, we are going to see a liquidation dive back to the pivot at 69,916. That's over 1,400 points of potential downside, more than half an ATR. Here's what the herd is doing right now. Retail sentiment across Japanese equity platforms is overwhelmingly long, and ETF inflows into Japan equity funds hit fresh weekly highs yesterday. The herd is euphoric, already celebrating a breakout that hasn't happened yet. Smart money uses that liquidity to unload into strength. When everyone is already positioned for the melt-up, the risk shifts to a trapdoor pullback. So I'll say it again, 71,643 is the line. Above, we flip fully bullish. Below, with a rejection candle, we short. Let's walk the chart from the weekly down to the 60-minute because you need to feel the pressure building. The weekly time frame is a masterpiece of trend continuation. Price is miles above the weekly MA20. That's way down near the 61,000 region. The MA60 and MA200 on the weekly are also sloping higher like a staircase. As long as that holds, the multi-month and multi-year bull trend is intact. But weekly stochastics are embedded above 90, and while they can stay overbought for weeks, they also plant the seed for sudden weekly wick downs that erase weeks of gains in 2 sessions. This is the tension we are trading, drop to the daily chart. Here, we have the clean moving average ladder that defines every dip as a buying opportunity so far this year. MA20 is at 69,421. That sits just above the pivot zone. MA50 at 66,116 and MA200 at 57,512 are so far below they seem irrelevant, but they tell you one thing, trend strength. The ADX on the daily is 45. That's not just trending, that's a locomotive. And yet, look at the candles. We are right at resistance 1, 71,643. This level has not been tested since the recent breakout leg began in earnest. ATR is 2,013 points. That means in a single day, this index can swing over 2,000 points. So when I give you a scalp target of 300 points, that's a tiny fraction of the daily range. We are playing with precision in a wide-botted market. Now, here's what most traders miss. I'm taking you to the 4-hour chart. Price has carved a series of higher highs, but if you pull up the MACD histogram, the peaks are getting shorter. That is classic hidden bearish divergence. Momentum is not confirming the new price highs. The MACD line is still rising, the signal line is still positive, the absolute reading is 1,430, but the histogram is compressing. Institutions watch this divergence because it often resolves with a sharp snap back to the 4-hour MA20, which currently sits near 70,200, right around the pivot's gravitational pull. The daily RSI at 59 is still benign. That's what makes this dangerous. Traders look at RSI 59 and think, there's room to run. but the stochastics on the 4-hour and the daily are pinned at 95, and the Williams %R is minus 3.8. That is a coiled spring. When Williams %R is that close to zero, it means we are at the extreme top of the range. Every single time it has reached these levels without a prior consolidation, we've seen at least a 38% retracement within 3 to 5 sessions. So the hidden divergence plus the oscillator extremes equal a high probability reversal zone. Now, let's anchor our levels. Support and resistance are your map. Resistance R1 is exactly 71,643. That is the immediate ceiling. Above that, R2 at 72,591. That's where a confirmed breakout could stretch. R3 at 74,318 is the outlier target for a full-blown melt-up. On the downside, support 1 sits at 68,968. That's not far below the pivot 69,916, which itself is the central gravitational level. MA5 at 70,787 and MA10 at 70,341 are your first dynamic supports within the intraday structure. But in a momentum market, those Mars can snap like twigs if the herd flips. The line I'm watching most closely after 71,643 is 69,916. A daily close below that pivot would turn the short-term structure bearish and open S2 at 67. 241. Cross-asset linkage is screaming here. Nikkei 225 is trading like a derivative of US dollar to Japanese yen. The yen has been weakening, sitting on the edge of that 160 intervention ghost zone. Every tick lower in the yen pumps exporter stocks, which dominates the Nikkei. If the Bank of Japan even whispers about intervention or a surprise rate tweak, yen strength will kick the legs out from under this index. Likewise, S&P 500 futures overnight are grinding into their own resistance. If US futures roll over during the Asia session, the Nikkei will follow within minutes. And Bitcoin, our risk asset shadow, is testing a key liquidity level. When crypto dumps on leverage flushes, the Nikkei tends to catch a sympathy drop within the hour. That's the web we are entangled in. The 24-hour news flow is thin, but the deep narrative is everything. The market is pricing in continued Bank of Japan dovishness despite global central banks creeping toward cuts. Japan's real rates remain deeply negative, and that carry trade fuel is the oxygen for this Nikkei rally. Institutional ETF flows into Japan equities have been accelerating. We've seen 3 consecutive days of net inflows above the 20-day average, according to the positioning data I track. That money is chasing performance, but it also creates a crowded trade. When the crowd is this long, the pain trade is a sudden correction. Look at the yield spread between US 10-year Treasuries and JGBs. That spread has widened again, which mechanically weakens the yen and pushes the Nikkei higher. But any hint of a US recession scare or a flight to quality bid into the yen would invert that dynamic in a heartbeat. And tomorrow we have US ISM services data dropping. That number has the power to either reignite the global growth bid and send this index through 71,643, or trigger a risk-off that pulls it straight back to the 69,916 pivot. So my 1 to 2 week directional lean is this: I am bullish above 69,916, but I will not trust the bullishness unless 71,643 is taken out with conviction. My medium-term invalidation is a daily close below 68,968. If we lose that, the trend is not just pausing, it's breaking down, and I'll be looking for 67,241. The fundamental trigger that would invalidate this bullish bias completely is any BOJ communication that signals a policy shift, even a small reduction in bond purchases, or a sharp reversal in US dollar to Japanese yen below 155. So ask yourself, do you think the Nikkei closes above 71,643 this week? Comment break if you see the melt up, or reject if you think the wall holds. I'm tracking the consensus of this channel live. Most people skip this section. That's exactly where the money is made. Keep watching. I'm going to give you 3 setups, not vague ideas, but precise triggers with price levels that you can set alerts for right now. These are designed for the ATR environment we are in, so the stops and targets respect the daily range. Strategy 1, the opening scalp, scalping, high probability. This one is a rejection play at the wall. The trigger condition. Price pushes into 71,643 resistance zone on the 15-minute chart. Prints a clear bearish engulfing candle or a shooting star with a wick rejection. The exact entry I want is 71,620, which gives you a small confirmation buffer below the high. If the 15-minute candle closes below 71,600 after that rejection, the probability increases. I set my stop loss at 71,730, 10 points above the recent swing high and above the psychological 71,700 level. That's 110 points of risk. My first take profit target is 71,300, a clean 320 points, giving a risk to reward of over 1 to 2.9. If the selling gains momentum and the 5-minute chart breaks below the MA10 at 70,341 later in the session, I'll trail my second target to 71,000. The invalidation is simple. If price closes a 5-minute candle above 71,650, the rejection failed, the breakout is happening, and I'm out with a tiny loss. No ego. The opening SCALP entry, 71,620, 15M bearish engulfing after tap of 71,643, stop loss, 71,730 take profit 1, 71,300 take profit 2, 71,000 risk, reward, (1:2.9R invalidation. 5M candle close above 71,650 voids the setup. Strategy 2, the liquidity grab, scalping, counter noise. This one hunts the breakout trap. The psychology is perfect. Retail sees a push above 71,643, thinks the breakout is confirmed, and piles in long. The institutions run the stops just above 71,643 and then reverse. Here's the setup. We wait for a spike above 71,643 that penetrates to around 71,700 or 71,720 within a single 1-minute or 5-minute candle, then immediately snaps back and closes below 71,643. The entry is on the snapback confirmation. I enter at 71,630 as soon as I see a 1-minute bearish engulfing closing back inside the range. Stop loss goes above the spike high at 71,760, risking 130 points. The target is the nearest intraday liquidity pool, which sits around 71,350, just above the previous consolidation zone. That's 280 points, giving a fast 1 to 2.15 risk to reward. This is a rapid execution trade. If the 1-minute chart does not show immediate rejection and instead price starts coiling above 71,643 with higher lows, I abort the short immediately. The danger is a genuine breakout that doesn't look back, so speed is everything. The liquidity grab entry, 71,630, 1M. Bearish engulfing after false break above 71,643, stop loss, 71,760 take profit 1. 71,350 risk, air reward, 1:2.15R invalidation, no snap back within 2 minutes. Price holds above 71,650 with higher lows. Now, before I give you the swing trade, I need to know where this community stands. Are you scalping or swinging this week? Comment scalp or swing. I'll read every response and pin the most detailed game plan. This feedback shapes the levels I prioritize in tomorrow's video. Strategy 3, the session swing, trend alignment. This is the trade that captures the multi-session move if the breakout materializes. The trigger condition, a 4-hour candle close above 71,643. Not a wick, a body close. That confirms the breakout and shifts the trend into acceleration mode. Entry is at the open of the next 4-hour candle, around 71,650, or on a small retest of the broken resistance as support. If we get a dip to 71,550 and bounce, I'll add. The stop loss is placed below the structural swing low that formed before the breakout attempt. On the 4-hour chart, the last significant low is near 70,900. I set my stop at 70,880, well below that. That's a 770-point risk. Yes, it's wider, but this is a swing trade, and I am giving the trade room to breathe below the breakdown level. My first take profit target is a 2 at 72,591. That's a 941-point move from entry, giving a 1 to 1.22 base risk to reward. Not stellar alone, but when combined with a second target at a 3, 74,318, the math shifts, 2,668. Points potential, roughly 1 to 3.5 risk to reward. I will trail the stop to break even once price reaches 71,940, which is halfway to the first target. That locks in a risk-free trade. The invalidation that would kill my medium-term bullish view is a daily close below 69,916. If that happens, I cut the swing long entirely. This setup is not for the impatient. It's for those who want to ride the trend wave with a defined risk. The session SRNG entry, 71,650, for H close above 71,643, or on retest at 71,550, stop loss, 78.80 take profit 1, 72,591 take profit 2, 74,318 risk, reward, 1:3.5R, to TP2, trailing rule, move stop to break even at 71,940 invalidation, daily close below 69,916 before I close, let this sink in. Never risk more than 1 to 2% of your account on any single trade. Scalps demand even tighter risk because the frequency is higher. In a 2,000-point ATR environment, volatility can gift you huge profits or destroy you in minutes. No positions through high-impact news like the ISM data tomorrow, unless you're already in profit with a trailed stop. Stops are non-negotiable. This is how you survive to trade the next big move. The market doesn't care about your opinion. It cares about your process. Protect your capital. Here's the single most critical level for the next session. Write it down again. 71,643. If that level breaks and holds, we are looking at a magnet move to 72,591 and possibly a melt up to 74,318. If it rejects and we close below the pivot 69,916 within 48 hours, the monthly trend will begin to wobble, and we could see the fastest drop of the quarter. Tomorrow, the US ISM services report lands, and it will either validate the global growth bid or trigger a vicious risk-off rotation. I will have the updated blueprint 24 hours from now with post-news reaction levels. If this level breaks, the whole monthly trend flips, and I'll be here, in the same seat, calling it in real time. If you want the full breakdown on Bitcoin and the S&P 500 divergence that is flashing a warning beneath the surface, that video is live now. Tap the end screen. Then hit the bell so tomorrow's alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter, and it tells me to keep delivering these institutional playbooks directly to your screen.